Ujjivan Financial Services returned to profits in the June quarter but missed street estimates. Asset quality saw some improvement as well. Let's discuss the quarter gone by with the MD and CEO Ittira Davis. Also joining in from Bengaluru is my colleague Nishant Sharma. Nishant, over to you.
All right. Thank you, Neeraj. Mr. David, I want to begin by understanding, do you think the loan book growth of 30 to 35% over the period of 3 years is doable?
30-35% is doable. I mean, it's not something that we haven't done before, so I think it's doable.
And how has the MFI portfolio done in this quarter in terms of growth?
The MFI portfolio has done a fair bit, and it has done a good 12% additional disbursements were done during this period. And as you know, traditionally, the first quarter is a bit of a slow quarter compared to the second, third, and definitely the fourth quarters. So from that perspective, this is a good level of increase.
And where exactly is the growth coming from? Is it the MFI portfolio or the non-MFI portfolio?
Yeah, the loan book at the moment, about 9% of our portfolio is non-MFI, 91% is MFI. And going to say at the end of FY20, we are expecting the mix to be 67% MFI and 33% non-MFI. So basically 9% will go to 33% in the next 2 years.
Right. Now, if you look at cost to income growth ratio, it remains high at about 70%. By when would cost starts to stabilize?
Yeah, the reason for the costs being high is that we are continuing with our branch opening, which we will complete by the start of this financial year. So from Q4 onwards, I think we should be able to start stabilizing the cost-income ratio, and there will be a fairly good visibility on that in the next financial year. And we expect to end this year around 70%.
And to add to that, what is your guidance on cost to income ratio for FY19 and FY20?
At this stage, we don't have the guidance right now, but eventually our target is to bring it down to about 55% in the next 3 years, 2 to 3 years, yeah.
Right. And Mr. Davis, can you also tell me about, what are the new products offerings for the banking customers and what plans you have for scaling up different business verticals of the bank?
We are trying to grow the new businesses, which is the MSE and housing. We are also adding a few other products to our product mix, which is personal loans. And we also have our agri portfolio because, we have to open 25% of our branches have to be located in unbanked rural areas. So we are trying to make sure that these branches are also profitable as soon as they are able to cover their costs. So overall, the agri portfolio plus the personal loans plus the MSE, affordable housing, all of these, and also some amount of vehicle loans which we will be giving along with a third-party strategic partner. All of these will contribute to the growth of the non-MFI sector.
And also talk to me about the traction you are seeing on liability franchise. And deposit base growth is flattish on a quarter-to-quarter basis. What are your deposit targets by, let's say, FY19 end?
The deposits, which is going to be retail deposits, we expect that to reach about 3,000 crores by the end of this financial year. So the branches, we should have around 400 branches by the end of this year, fully operational, and rural branches as well. It will be about 400 branches.
Also, what about the kind of experience you're having in the products that are launched recently?
Yeah, I mean, in terms of sectors, the rural is working out well. We have JLG, which is doing well. And the business for the vehicle finance is also started off well. Slow start, but now we are ready to take off. And personal loans, we have finished the testing, so we should have a soft launch shortly.
Right. And what about asset quality trends in MSE and housing loan segments?
No, so the asset quality so far is good. We have not had any issues in the housing portfolio. And we also, as you know, we have also turned around on the MFI portfolio. So overall, our credit quality is something that we are quite proud of at the moment.
And lastly, Mr. Davis, you have shared high-cost borrowings. Do you think that it will still be difficult to expand net interest margins given the rising interest rates environment?
Yeah, the rising interest rate environment will provide a challenge, but we continue to have some of our legacy borrowings which will be running off the books, and that should help us to manage NIM, net interest margin, during the current financial year. Because those costs, those interbank deposits, or not interbank, sorry, those bank deposits were taken while we were still in MFI. So the interest rates we are paying there are higher than what we would be paying today. So anything running off our books will bring down the average cost of our funds and therefore improve net interest margin.